Hey, so lots going on since I've had this surgery in the middle of a layout here, and we haven't been able to update everybody as much as we would like to, but I'm glad that we're getting back on this now and ready to inform everybody what's happening because there's so much volatility out there, so much crazy, mad things happening out there in the real estate world.
Cash talks. Let's make that move. Talking homes, talk life, big plans to prove. Whether you're buying in or letting it go, you want smart listen from leveling the flow.
Hey, welcome back to Cash Talks, where we're talking real estate, rates, and real talk all the time. Let's get back to it. And I want to let you know why we're on a little bit of a hiatus. And that was because I had a surgery right on my eye, right over here. For those of you that don't know, I used to be a professional boxer back in the day, about 28, 30 years ago. I hung up the gloves. But as a result, I had a few injuries where they had to go in and cauterize my nose a little bit, and I almost bled to death one time, and they had to go into emergency surgery and put a metal clip on my artery right under my eye here, which stopped me from bleeding to death and saved my life. So flash forward to about 28 years later, I finally had it taken out. So it took a little bit of time. I was out for a minute, but I was working out of my house anyways. I was all black and blue, and I still got a little knot over here, but it's all coming together pretty good. So, and it feels great to get this big lump out from under my eye, which was a metal clip. They had a big metal ball, kind of a clip thing under my eye for almost 30 years. So it was crazy. And the doctor got in there, cut the artery, pulled it out, cauterized it all back together. And then here I am, alive. So, yeah. And I was away for the whole thing because I didn't like being put under anesthesia. I hate that. So I found a surgeon who would do it without the anesthesia. Win-win for me. We got it done. It was crazy. So anyways, we're back in action here. I got my infamous lender out of Glendale, California once again, Mr. Dave D'Souza. Welcome aboard, buddy.
Welcome back, brother. And it's good to have you back.
Yeah, thanks, sir. Thank you, man. Hey, so lots going on since I've had this surgery in the middle of a layout here, and we haven't been able to update everybody as much as we would like to, but I'm glad that we're getting back on this now and ready to inform everybody what's happening because there's so much volatility out there, so much crazy, mad things happening out there in the real estate world, the economy, the world altogether. But we're going to focus on real estate, interest rates, and how we could play this game of real estate to win in any market, especially the one we're in today. We have to really kind of pull back the covers and look inside and see what's really going on because everybody has so much information and it's all over the board. The news, the media, they're trying to push an agenda one way or the other. As we know, typically they're always doing that. And I think we're all getting pretty smart to that these days, that they're trying to push some kind of an angle. Some are reporting true news and some are off of it, right? For whatever reason. So, and there's a lot of scare tactics too when people go to YouTube and the different channels and they're watching all these things, or they see something on Instagram or Facebook. There's so much information out there. It's information overload, and it also becomes very confusing. So Dave and I, we're in this business a long time collectively between the two of us here, work on some very professional standards, and we want to bring you the information that you need to know, the correct, truthful information, with no bias, no agenda, no push, but we want you to be able to make the right decision going forward, and that's how we run our business. So we're going to help you answer some of these questions that are floating around out there. And there's quite a few of them. Dave, can you do us a favor and kind of fill us in on what's going on in the mortgage world with interest rates and those kind of things?
Yes, sir. My pleasure. So I'll give you guys a quick update on something here. First of all, as a side note, relatively new PRMI program, we have 100% financing for up to about 1.25 million on a single family and up to 1.6 million on a duplex in LA County. No first-time buyer requirements, no income limits. That's huge. That's a big ticket item that we've got there. So something you could certainly reach out to Cash. He'll tell you about it and put you in touch with me about it. The other thing, too, is if you are planning on filing your income taxes and you are planning on doing a mortgage transaction either later this year or in the early part of next year before you file your 2025 taxes, please consider letting me take a look at the drafts of the taxes before you actually file them with the IRS, so that I could take a look at them, work with your CPA and say, hey, if you got, something that you're claiming, I can help you figure out what's, what you may and may not be able to do so that it doesn't affect your qualifying. Quick recap on last week. We saw a slight improvement in interest rates. Our par rate went from 6.75 the week before down to 6.5% on a standard conforming this week. So not quite where I'd like to see it, but moving in the right general direction. Dropped about 0.25% from the week before. Stocks, on the other hand, took a little bit of reversal, 2% lower. End of the week, last week, Friday, about 2% lower than the prior week. One of the things that impacted the markets significantly last week is Federal Reserve Chairman Powell spoke on Friday. And part of the concern he has is the question of how tariffs might affect interest rates. The comments he made took stocks down and took interest rates up a little bit from where they were during the week. So it wasn't good for interest rates or stocks, because typically higher prices, tariffs typically mean higher prices means higher inflation. Higher inflation means the Fed may have to raise interest rates or not lower interest rates as much as they'd like to. So that's the overall scoop of what was happening with the markets last week. The other piece to take into consideration is consumer confidence, which is very, very important, because how confident consumers are has everything to do with what they spend and how they spend in this economy and in this market. And consumer confidence needs a little help. The average consumer right now is not as confident as they were some months ago. They're a little concerned. They're a little skeptical about spending on daily everyday items that you might think about. You going out to dinner, getting a pizza, or getting some groceries at the store. Just get what you really need. Maybe don't get the things that you don't really need. That kind of confidence needs to start working its way back up, and then we'll start to see an improvement in the economy. So that said, that is my quick recap. Cash, thank you for the opportunity to do that. I'm here to bounce off any ideas and questions and concerns you have. Take it away.
Dave, we always love your insight, man. Thank you, brother. Hey, I wanted to ask you, though, if you could fill everybody in on what a par borrower is. You were saying we're about a 6.5% for a par borrower. Can you tell everybody what that is?
Well, it's actually par pricing, not a par borrower. So for any given borrower, there's going to be a certain price matrix that is generated based on the credit, based on the debt ratio, based on the loan amount, based on the type of property they're buying, based on what kind of property they're buying, what their intention is. Par pricing is pricing where you are not paying money to buy down the interest rate. So par pricing means if you take that rate, you will not have to pay money to buy down the interest rate. So essentially, and you'll find that our par pricing is a little more aggressive than most, just because of where our margins are, and also because of the fact that we're a very large company and we price aggressively. But as an example, at a par price of 6.5%, that means if you want below 6.5%, you're going to have to pay discount points to buy the rate down from there. On the flip side of the coin, if you go above 6.5%, then that may be money that you could get credited back from the investor towards your closing costs or other fees. Gotcha. So, and of course, if you were to take the 6.5%, and that's where your profile puts you at a 6.5 at par, that means you would neither get money back nor need to buy the rate down. You could get that 6.5 and just have your standard closing cost. Does that help?
Yeah, no, definitely. That puts some clarity on that.
Yeah, and just to be clear, par refers to the pricing, not the borrower, because every borrower has a slightly different profile.
Right.
But par pricing for any borrower is the pricing, not the borrower.
The pricing. And I imagine credit scores, FICO, DTIs, debt to income ratios, and all those things will come into play too. What do you call that when you place a borrower from a well-qualified borrower to someone that might be a little more marginal?
Well, they're all respected and appreciated borrowers. The point would be, like, let's just say you take somebody who has an 800 credit score. And at an 800 credit score, they're going to get their par price is going to be 6.5%. You take a similar borrower that has everything else the same, but instead of an 800 credit score, maybe they have a 640 credit score. So now you're going to be looking at something probably closer to 6.99, maybe even a 7% par rate. So, but that's the incentive to say, hey, we have programs that work for people that don't necessarily have the best credit, right? But the rate is going to be impacted by the credit score. That is the single thing that impacts the credit score more than most other things is going to be your credit score. Now, one very important thing that I can offer you is, as part of our team, we have what we call a credit score rescore process. So if we run your credit, we see what your score is, we can take your credit report, put it through a simulator, and that simulator will tell you what it is you need to do to get your credit score from where it is to where you want it to be.
Gotcha. Okay. That's good news. Great to hear that. All right.
Something we've always had, but depending on how challenged the borrower is, we have more or less work to do there.
Dave, let me ask real quick. In today's market, or at the last 6 months, years since it's been a while since we've been in this high interest rate environment. What are you seeing as far as people buying rates down, maybe on a percentage angle, and like how much are they buying it down? Or are you seeing most people just go forward with what the rates are today?
Most people are taking par rates, or even some of them slightly above par, where they get money back. And the rationale behind that is this. If we were in an environment where, like we were in 2020, 2021, the early part of 2022, where rates were in the 2s and 3s, yes, spend the money, buy the rate, because you're probably not going to see that again. With rates where they are right now, the rationale is, well, it's fairly likely that they'll be lower at some point. So why would you spend money to buy down an interest rate now, when you might be able to get that lower interest rate in a matter of months or years, within the next 6 to 12 months? You could get that lower interest rate without having to spend the money to buy down.
Gotcha. Yeah,
buying down an interest rate is almost always, and academically speaking, buying down an interest rate is a long-term decision, not a short-term decision.
Right, absolutely.
So if you're looking at a horizon of 6 to 12, maybe 18 to 24 months, I dissuade clients from spending money to buy down the interest rate. However, many of our clients, as you and I knew, when they had interest rates, let's say you could get a 30-year fixed at 2.99%, and you thought you were going to keep that house for a good long time, it would have made all the sense in the world to say, well, maybe let me spend a point, maybe even 2, and buy it down, to
Right.
2.5, 2.625, 2.375, because we won't be touching that loan for a good long time to come. Right. That is a great segue into something that you and I have discussed a lot on our podcast, which is people that are interest rate prisoners.
Yep.
Some of these people that got the 2.5, the 2.75, the 2.875, the 3%, the 3.25% rates. And now they're in a situation, well, they got to move. They'd like to move. They don't necessarily like their house. They don't necessarily like their neighborhood. They've outgrown the house.
Right.
And in some cases, they're just like, man, I would love to move. I want to move here. I want to buy this house. But I've got the 2.99% interest rate. So
That's a tough one. I get it. It's a tough one.
I have to stay here in this miserable house with this miserable neighborhood.
Yeah.
But I got my great interest rate,
Well,
right? Interest rate
screaming and hollering all the time, whatever they're doing, right? We need to go. And then at some point, you just have to go. Maybe it's work that's moving you, or whatever the case might be.
You could even segue into, how does that tie into inventory? How does the fact that there's so many people that are interest rate prisoners, how does that tie into inventory right now?
Well, it has been holding inventory back for a long time. That's exactly what now, And then we've had a good demand, but now the demand, as the rates have gone back up again, that kind of slowed it down a little bit. And our inventory has been picking up across the nation. Let's talk about some numbers in real estate and what's going on in the 3 markets that I work in Santa Clarita, California, and the surrounding area in Southern Cal, Las Vegas, Nevada, and Boise, Idaho, the Treasure Valley area up there. I'm going to break down some numbers for Santa Clarita right now, because I dug deep into these right now, and they're pretty interesting because it's going to basically correlate with what's happening in the rest of the nation right now, because we're seeing an increase in inventory. Okay, we've seen a little bit of slowdown with buyers because of interest rates, and also there's more selection. We're seeing days on market have picked up in just about every city across the country. They fluctuate, of course, in every city, but that's what's happening overall. Inventory picking up, demand slowed down a little bit. It's still selling. Houses are still selling, sitting on the market a little bit longer. You've got days on market have increased. Santa Clarita, let's talk about 2024 and then 2025 with the numbers right now. In 2024, at this time of year, we had 348 active listings in all of Santa Clarita. Okay, that's including Agua Dulce and Acton, for those of you in the Santa Clarita market area, and all the other cities that make up our Santa Clarita market. 348 condos, houses, townhomes, everything. Not much, okay? Not much. That's a really low number. And that was even up because we were down in the 2s for a while. So today, let's flash forward to today, 2025, we're at 660. So we have getting close to doubling our inventory level. And plus, we also have another 295 actively pending as well right now. Last year at this time, we had pretty close to the same way, 303 pending at this same time last year. Okay. So we had a lot less listings last year. Okay. But we also had about the same amount of pendings, meaning our absorption rate, with active listings and those that are going to escrow and getting off the market, right? Which that number is very close to today. You're looking at about a 32% today based on that higher number of active listings. I hope I'm not getting too confusing here. And then 47% was the number of pendings last year at this time, with 348 active listings. So the point of the story is we are still having a good amount of sales, although it's slowed down, but our inventory has picked up. So the good news for the buyers is they have some more things to look at. It was ridiculous taking buyers out a while ago because there just wasn't a lot to look at, and they were moving pretty quickly. You need to come in with a really good offer, play some of the game where you're removing contingencies, and maybe going over asking price, and your agent coming back going, "Hey, there's 10 offers on the property. What do you want to do?" That kind of song and dance. I have seen that on some properties. I've sold a few myself recently this year where we had 8 and 10 offers on the property first weekend. These are really nice properties and great properties, great areas, marketed correctly and priced correctly. And if you do that, bam, it's going to move, right? The problem is there's a lot of people that are still overpricing properties. So we see in your Redfins and Zillows and Realtor.coms out there, you look for the analytics and you see price reductions. So people instantly, and I get it, they instantly think, oh my God, the market's coming down. No, you can't use that as a measure. I'll tell you why. Because it's the sellers that have put those prices on the property and they overprice them. They're getting overexcited, like, hey, my neighbor's house just sold for this, so I could price it a little bit higher. No, not necessarily. Listen, to maximize the sale of your property when you're ready, pricing is very important. You need somebody that really needs to sit down and go through the whole pricing structure with you and the different strategies that you could apply putting your house on the market. Super, super important. Please don't overlook that. Don't just come up with a price. Don't look at Zillow's estimates. I'll tell you a real quick thing, Dave. I don't know if you're familiar with this, but there are 12 states in the United States that are non-disclosure states, right? Which means when you sell a house, you don't have to report that sale to public records, right? So MLS has it, but it's not public record. So the Zillows out there and these different companies, they can't get hold of that sale price. So when they run their estimates or their whatever kind of estimate they're running from whatever portal we're talking about, Redfin, Realtor.com, or whatever, they can't get accurate information because it's in a non-disclosure state. So if you're living in a non-disclosure state right now and you're looking at Zestimate, trying to really, formulate a value on a property, you're making a big mistake. So you want to get a local realtor. You want to look at the appraisals. You want all of that in your on the desk for you, because you really need to make a really solid decision on understanding the true value of the property, not what Zillow is saying, not what Redfin and all these other companies are saying. Have you ever run into that before, Dave?
Oh yeah, well I wasn't, until you brought it up recently. I wasn't aware of the states that are non-disclosure. It would almost make sense to me that all states should be disclosure, because if you want to have accurate data,
right?
How do you get accurate data if there's private under the cover sales that nobody knows about? They could be high, they could be low.
Yeah.
And they could definitely skew the median and skew the outcome.
Right.
So
well, you could come up with the value, but you just have to look through MLS.
That's what I'm saying, is you'd have to go through an MLS or you'd have to go through an appraisal. You can't just look at comps. Right.
And even in states that are full disclosure, California being one of the non-disclosure states right off the bat is Idaho. That's a state where they don't disclose a non-disclosure
state. So it means a closed sale is reported on the MLS, just not to public record?
Exactly. Yeah. Right. So for people that are looking at the estimates on Zillow and those kind of things, they're going to have a hard time. Even if you're looking at Zillow in a full disclosure state, even Zillow will admit they have an 8% margin of error, one way or the other. So,
8%.
Sorry?
8% margin of error.
8% was
that means if they told you your house was worth $100, it could be worth as little as 92 or as much as 108.
Yeah, and if you got that house, I want to buy that all day long.
Wow.
I'll pay your 108. I'll take the 110. Let's go. Come on.
Yep.
So there's some numbers there for you in Santa Clarita, very representative of what's happening across the country and all these other states too. As the ones I know, it's a fact. I'm working in Idaho and in Las Vegas, Nevada too. Las Vegas has still been pretty good. There's always people still moving here. Idaho is still very popular with the migration from California, is still heading that direction. Seems to be a little more going to Las Vegas these days. And that's what I'm seeing right now. So it's been great. But one thing I wanted to add, although there's been an exodus out of California since COVID and through some of these years here, there's still people buying the homes and moving in there. They're coming in from New York, they're coming from other countries, other states around the United States. They're still moving into California. And those people that are leaving, someone's buying their house. There's lateral moves all the time, yes, but there's still people coming in from all these other states and out of the country still. So California is still holding real good value. I don't think it's ever going to really lose any real value at the end of the day, in my opinion. But so, and with this exodus, we got to ask ourselves, why are people moving out of California? What is the real reason? Well, it's a mixed bag, of course, like always, but a lot of retiring. People that are retirees are going to other states where they could get more bang for their dollar and maybe just a little different way of life. So, Dave, how about you? Are you seeing a lot of people coming in on the lending end of things? That are they coming in from other countries, other states? What are you seeing?
It's interesting. I'm seeing about a 50-50. I have clients that are selling and moving out of state, and then I've got a fairly decent amount of people that are actually relocating back into California. And I would say it's actually fairly close to even.
Yeah.
The people that are coming to California are primarily coming because of job relocations. And that's where they can afford to, because if the cost here is more expensive, so are the wages.
Gotcha.
And the people that are moving away or people that are leaving, in my experience, typically tend to be people whose income may be changing, such as going from employment to retirement or something like that, or just cutting back on income, or maybe two people working and now one of them is going to work so the other one can raise children. In a situation like that, typically when there's going to be a reduction in income,
right,
is when I see people wanting to move out of state. And that's because while wages may be less in other states, so is the cost of living. But on the flip side to here is you might have a higher cost of living, but you also have the potential for higher wages and higher income. So it's just really a sort of a toss-up as to which way that goes. I'm not seeing what one might describe as an exodus out of California. Okay. I'm seeing people moving out, but I'm also seeing people moving in.
Right. Yeah, like always, right? Seems like the exodus thing has kind of slowed down quite a bit from what I could gather anyways, but we still have Californians coming to Idaho and coming to Nevada all the time. I'm seeing it all the time. But we're also
there's an important piece to just throw in here. California by itself, up until fairly recently, was the 5th largest economy in the world. And I think now it's past one of the other countries, either Germany or somebody. So now California on its own, just the state of California, is arguably the 4th-ish largest economy in the world, behind, large economies like China and, of course, the United States, and I think Japan. So, when you look at it that way, with the fact that California is its own, like literally almost its own economy, the opportunity to earn money here is decidedly greater than it could be in most other states, if not all.
Absolutely, 100%. Yeah,
and I'm not just saying that because I do business in California. I'm just speaking statistically speaking. I mean, the state on its own, like I said, is the 4th or so largest economy in the world. That says a lot.
Yeah, absolutely does. Big time. Screaming. Yeah, we're paying that high weather rent or weather tax, if you will, to live in the state of California. But, a lot of times it's well worth it, Plus the opportunities are there and the potentials for earnings are there as well, so you can't overlook those things, right? And quality of life, that's always something that people got to really look at too. So, well, Dave, what's going on with the Jerome Powell? Anything we could share with our viewers out there about Mr. Powell that you have?
Again, this is factually speaking, the Fed has always been in this predicament where they use interest rates to try to balance. In other words, they try to bring rates down to help consumers have more access to money.
Right.
But in doing so, sometimes the consumers end up being their own worst enemy and spending so much that it causes prices to go up. So the Fed is always trying to dance a fine line between making sure that rates are low enough to inspire and ignite spending from consumers, but are not so low that it causes inflation. So they have to walk this line where they're keeping them low to help, things move along,
Right.
but they're also not letting them get too low, because then if they get too low, then prices will go up and inflation will go up. And before you know it, you'll be seeing what happened where we saw interest rates go from the 2s and the 3s up to 7-8%. So
Right.
there's a few different things. One of the other things the Fed tries to do while they're sort of balancing all this is keep an eye on jobs, wages, wage growth. One of the challenges with the Fed is that a lot of the data they're looking at isn't necessarily immediate or fresh data. Sometimes it is, and sometimes it's not. And so I certainly don't envy Jerome Powell or the Federal Open Market Committee for what they have to do. It's a very serious job trying to make sure that, we keep us from having inflation where rates go too high,
Right.
but at the same time keep rates low enough where people can buy.
Exactly. Yeah,
That's a very delicate balance.
Yeah, very delicate balance. Absolutely, 100%. Well, when is the next Fed meeting? Do we have on schedule?
Well, I think we had one. I believe, in early April. So I would imagine the next one is probably in June. I have to check and see. I don't know exactly when it is, but I will be sending out a market update of when that is.
Okay.
And it's really up in the air as to what they're going to do right now. One of the things that's sort of thrown a little bit of a wrench into what their already complicated plan is at a certain point in the very near future, many of these tariffs that have been introduced by the current administration are going to start taking effect. And when these tariffs take effect, it's going to cause prices to go up. That is definitely and completely going to have an effect on inflation, which is something that Jerome Powell commented about just on Friday when he had a press conference. He commented on it, and the market did not react well to his comments. As a matter of fact, just this past Friday, he said there was a concern that with tariffs causing inflation to go up, the Fed ideally would want to lower interest rates to help spending, but they also have to be careful, because if they lower interest rates and prices are going up, that could cause a flip side issue.
Right. No, absolutely. Yeah. Well, as far as the averages for interest rates, speculations between now and through Q4 of this year, they all stay pretty close, tapering down a little bit more towards Q3 and Q4, but still in that low to mid 6. I think the lowest they speculated was a 6.37 for this year between your Realtor.coms, your Zillows, your Fannie Mae, Freddie Macs, your MBA, and all of them were kind of pretty close to the same range. So, and I guess my point of this is that if you're a buyer and you're waiting around to see some miraculous lowering of the interest rate, I don't see it this year. I see maybe a little play, as we have seen already, some volatility. There's been some moments where if you're ready to jump on an interest rate, you could have done pretty good just
well, even fairly recently, we've been very, we were down at 6.25, 6 1/8.
Right.
I mean, we were dangerously close to the 5.99 that we wanted to see.
Right.
And then, the tariffs happened and just kind of went the other way. And now, people are sort of concerned about investing in the bond market. One of the things that I'm somewhat hopeful for, and again, I don't know if this is empty hope, but one of the things I'm hopeful for is if we see any sort of negotiation or relief with respect to these tariffs, it'll have two positive effects. Number one, obviously it'll help the stock market. But number two, for our purposes and for buyers, it will help the bond market. And if it helps the bond market, which, will cause prices to increase and yields to go down, increase the appetite for bonds. That would be a significant issue, a good thing, because with the easing of tariffs, that would take the fear of inflation a little more off the table for the Fed, which would mean the Fed could actually look at, stepping in and lowering interest rates to help get things moving without the fear of inflation from tariffs. So I'm hopeful that we'll see something like that come around. I mean, again, out of yours and my hands. But at this particular point, I'm really hopeful that if we see any sort of tariff relief, that could have very positive implications for both interest rates and the stock market.
Okay. Yeah, exactly. Agreed. 100%. So, again, if you're thinking of selling or buying and the interest rate is really playing a big, big role in your decision making on this, and maybe Uncle Bob or the news or somebody's filling you in at a at a backyard barbecue somewhere that, no, just wait, the rates are coming down, the market's going to crash. I've been hearing this story for years and years and years, and I know buyers and sellers that have waited and waited and waited for the perfect moment, and it just does never seem to happen. And then if it does happen for a small window, they're not ready to make the move at that point anyways. So again, the rates to get down to where they were into those high twos, right? Something catastrophic, again, we've talked about this before, Dave, is going to have to happen, like a COVID, like a war. And none of us want that to happen just to get a lower rate.
If things go the way they've been, I would say the chances are very slim to practically none that we're even going to see rates in the 3s, even the 4s. I think at this point, if we see rates get down to 6-ish, high 5s, everybody needs to put on their sneakers, with the cleats, and go sprinting for the nearest real estate office.
Correct, because it's going to get busy, folks. It's going to get busy. There are so many buyers on the fence, and inventory's picking up because there are sellers that rate fatigue we talked about earlier, Dave, has set in. And they're like, I'm not waiting any longer. I'm going to go ahead. I'm going to go forward. I'm going to put my house on the market. I'm going to sell it. And I'm going to have to go buy something at a 6-ish interest rate. And they could either do the buy down, right? Because they know they're going to be in that house for a long time. Or they could play the game of maybe do a short-term buy down. We didn't talk about that earlier, but there's that option available too. They don't have to buy down as much, but they could get it maybe to a better reasonable number for them that makes them feel comfortable. A lot of times it has something to do with the DTI, right? They've got to get that number down to afford that monthly payment that they're all looking for, because a lot of times it boils down to that. But also remember, we still have a lot of people paying cash out there. And Las Vegas has been the #1 city for all cash purchases last year, and it's looking like this year too, starting out pretty good already. So there's a lot of cash out there. There's a lot of equity. There's a lot of strong home ownership out there. Last time we reported, it was around almost 40%, 39% of homes have no mortgage. No mortgage. This is the highest number on record of 39% of homes with no mortgage that I've ever seen. So keep those things in mind. It might help you make a better decision one way or the other. Do I buy? Do I sell? Do I wait? Do I stay? What do I do? Right? Or call us. Call myself or Dave. We are happy to sit down and go through what's going on today and what the speculations are for the nearest future, because none of us know what's going to happen in a year from now or even 6-8 months from now, because it's been so volatile. But we can share with you what we know today and what we've seen in the past and what we feel is going to happen in the near future. Right, Dave?
Absolutely.
Right. So
the only thing that's for sure is that nothing's for sure except what's right now.
I love that. What's for sure is nothing's for sure except for what's going on right now. 100% agree with that, Dave. Great having you back on board. So if you want more cash in your life, just go ahead and hit that subscribe button, and we'll be seeing you next week for anything real estate, rates, and real talk.
Cash talk. Let's make that move. Talking homes, talk life, big plans to prove. Whether you're buying in or letting it go, you want smart listen from leveling the flow. This the place where the info don't stop. Cash talks, yeah, you know it don't stop. Real talk, real keys, real goals on lock. From downtown dreams to the burbs of blocks. Turn a key, feel the beat, that's Cash Talks. Cash Talks. Cash Talks, you feel that spark. It's real life info that leaves a mark. Tune in weekly, make your mark. This show's got heat and heart. Cash Talks, you feel that spark. It's real life info that leaves a mark. Tune in weekly, make your mark. The show's got heat and heart. Cash Talks. Cash Talks.